Our first session today is an interview with Andrew Cowley, the manager of Impact Healthcare REIT. We'll be discussing the prospects for the UK care home market, as well as Impact's portfolio and strategy. Andrew, thank you for joining us today.
Thank you for having me.
Could I start by just asking you to talk a bit about your outlook for the UK care home market at present?
Well, you might be surprised to hear it's positive. We think there's an interesting outlook for investing in UK care homes. So how can I say that at such an uncertain time? We've got the tragedy of a major war, interest rates going up, inflation going up, and the pandemic's still not over. So we understand it's a very challenging environment. But a couple of things we think make our investment market slightly different and attractive over the medium and longer term. So the first is the most basic, it's supply and demand. So supply of good quality care homes in the UK has been stagnant for the last 10, 15 years. And we know demand is going to rise because we've got a rapidly aging population. The key demographic for people who need long-term care, good quality care home, are people over 85. And that's the fastest growing part of the UK population. So this demand we know is going to grow, and it's not discretionary. So it's not linked. If there is a linkage between demand for that care and what's happening in the headlines today, I'm not intelligent enough to understand it. So we've got a very interesting supply-demand dynamic. And the second thing that makes our market slightly unusual as an investment market is how, we might come back and talk about this a bit more in terms of deal flow pipeline and how we can grow the platform, is how fragmented the market is, which means you've got to be very, very careful about what you're doing. You'll be very selective. You've got to do more than just due diligence. You've got to really understand your counterparties and form long-term partnerships with them. But if you can do those things, it means you can acquire on very attractive terms. And again, that is not cyclical. It's not that something happened which makes those terms more or less attractive suddenly. So as long as our job is to think about the longer term, be very selective in what we do, but keep steadily going rather than trying to market time and second guess what might happen next. We don't need to do any of that.
So has your outlook changed at all given the recent social care reforms announced by the UK government?
Yes and no. I mean, we were expecting these reforms. I think the pandemic has accelerated a number of trends, and one trend it did accelerate was the need for the government to do something. That need's been there for 20 years. For the past 20 years, various governments have come and gone saying we're going to reform and improve adult social care and have not got round to it. The pandemic took away the option of doing nothing. The government has to do something. So I think when you look at what they announced at the end of last year, it's very easy to pick holes in it and say they haven't done this and why did they do that and this is not enough. So will there ever, given what I just said about demand, there probably would never be quite enough money. There's always going to be need for more money. So our view on the reforms, which they've got three aims: to increase funding for elderly care, improve access to it, because there's a de facto rationing going on at the moment, people just not getting access to care in a timely way. So improve access, and hopefully to improve the quality of care. And when you stand back and look at those reforms, I'd say they're serious, they've been passed into law, so it's not just a green paper talking about what we might do. They've actually done things, they deserve credit for that. Is it complete? No, but we think it's a major step in the right direction.
And are there any other regulatory risks?
There's always, so we're investing in a form of social infrastructure, and infrastructure is always regulated. So I was going through this with a manager of one of the homes we own the other day, about quite how many policies she has to have to comply with various regulatory standards. Obviously with CQC in England, the Care Quality Commission is the main clinical regulator, but there are literally dozens of other regulatory agencies, health and safety, fire, training, lots of things. And she worked out she had to have 328 policies in place at any one time to be in compliance with all the various regulations. So our tenants operate in a highly regulated environment, which we think is a good thing. It hopefully helps to improve quality and transparency, and there's a strong compliance culture. But the flip side of that is, yes, regulations can change, and it's quite common. I think lots of us see this in other parts of our lives, but different regulatory regimes don't quite fit together, and you're being pulled in different directions. So it's not easy. And you've got to keep a very careful eye on how regulations are evolving and where they don't fit together.
And moving on to the investment side of the market, Are you seeing significant yield compression in the sector?
If I'm honest, we were a bit worried about that last year because it was going to, so I think a number of different investor groups noticed a couple of 2 or 3 things in the last 2 years. First of all, healthcare and care homes in particular have been, to the surprise of many, we weren't that surprised, but to the surprise of many, very resilient during the pandemic. The yields you can achieve on buying these assets are high relative to virtually any other kind of operational real estate, and the government reforms you just mentioned. So you add that up, we were seeing new investors coming in, and it wouldn't take, we think, many new significant investors coming in for yields to compress quite tightly. The big group who came in last year were European care operators and landlords. And they've had, at the beginning of this year, they've had some issues back at home, which I think has made them slightly pull back. But they'll reappear.
Thanks. And obviously, inflation is a big topic of conversation at the moment. Are your tenants particularly vulnerable to rising wages or other costs?
That's something we gave a lot of thought to when we were setting up the business. And because we wanted to make sure we built as much resilience as possible into the business. And we've got protection against inflation at a couple of levels. So one level in our leases, 100% of our leases are inflation linked. So annual rent increase linked to inflation. That's 100% of our leases. But you can write anything you like in a lease, the question is, will it work? So our tenants, at the second layer of protection, have a high level, because what they're doing is essential, it's non-discretionary. If you put it the other way, they've got a high level of pricing power. What they do has to be paid for, one way or another. So to come back to the question about, so hot topic at the moment, literally hot topic, gas and electricity. So our tenants last year in 2021 spent 2.1% of their revenues on gas and electricity. They spent 3.6% of their revenues on food. So if those costs rise 25%, it will reduce our tenants' margins by just over 1%, assuming they can't pass the cost increases on to their residents. But one thing interesting me actually was that their spending on gas and electricity and food last year was lower as a percentage of revenues, was lower than it was in 2017. So but let's see, I think we're all expecting some very substantial increases in utility pricing and maybe food, but our tenants compare that.
And the underlying rent cover is?
So the underlying rent cover for last year, for the full year, what we mean by rent cover is home level profitability divided by the rent owed on that home. And it's a very important, when we're looking, I think we might talk later about how we go about acquiring things, what we're looking for, but it's a very important metric, we think. You've got to get, if you start off over rented, you're going to dig a hole and the rent will be at risk. It's very important to get the initial level of rent right and not be over rented. For last year, for the full year, our average rent cover was 1.9 times, which actually is slightly higher than it was immediately pre-pandemic.
Drawing on from that, what are the key things that you look for when you acquire new homes? Is it mainly the tenant quality or is it other things as well?
This might sound odd coming from a real estate investor, but we think the buildings are the easy part. I mean, you can assess a building, you can work out is it good quality or not, could it be improved, can it be enhanced, can it be expanded? That's the easy part. The key part is who is going to operate that building for you, who is your tenant? And that's where you've really got to focus on very careful tenant selection. And we like to spend, we now have 13 tenants. We began 5 years ago with one tenant. We've added 11 since then. Well, initially, we had 2 tenants day one, but part of the same group. We've added 11 more since then. And we like to spend a lot of time with a potential new tenant, not just talking about spreadsheets and legal agreements, but with them, walking around their homes, getting to understand how they operate, who they are, who their key people are. Obviously, some of that was challenging during the pandemic, so we did suspend new acquisitions for 6 months during 2020, because you can't buy care homes unless you've spent time with a tenant and actually physically be around those homes, and that was not possible. So we suspended acquisitions for about 6 to 9 months in 2020. So tenant selection is the single most important thing I think we do. And having worked out you want to buy these buildings and you want this tenant to run them on your behalf, we're putting in place very long-term leases. Our WALT's 20 years. Typically, we're putting in new leases for 25 to 30 years with no break clauses. So it's a very long-term partnership. As I just mentioned, the next most important decision is getting the initial level of rent right and making sure you're not structurally over-rented, because our 100% of our leases are inflation linked, and we've got to be comfortable that that is going to be, as my partner Mahesh Patel always put it, we didn't use the word resilience, that both sides, the tenant and the landlord, have got room to breathe. And we knew there were going to be bumps in the road. We didn't expect a bump like a pandemic, but we knew things are not straight line, problems happen. When they occur, both sides have got room to breathe, both are profitable, and it could be a successful partnership.
And during the pandemic, Impact Healthcare was able to stay resilient. So the key reasons for that, do you think, was the tenant choice? And
I think probably I've covered some of it. So the way we can point to our resilience is the most basic thing in any real estate platform is, do you have any voids? Are your buildings rented? 100% of our buildings are rented. We have 0 voids. And our rent collection record from inception has been 100% through the pandemic. So we have not had a single problem with being paid rent through the pandemic. It would be great to be sitting here saying that if our tenants were really struggling, but the rent cover number I've just mentioned shows they've been working very hard, and they deserve huge respect and thanks for all the work they've been doing, but they're not struggling, and we're not putting undue pressure on them. So that's the main part of resilience. Something I haven't mentioned, though, which we did deliberately, is balance sheet, is to make sure that we're always running a safe, conservative balance sheet. So actually for our first year of life, we had no debt at all. Our LTV at the end of last year was 22%. We've reduced it since the end of 21 through doing a small equity raise in February. But we've always run a very conservative balance sheet.
And are you happy with that level of gearing?
When we went into the pandemic in March 2020, our LTV at that point was just over 6%. And this is on a, without getting too technical, so on a gross basis, not counting cash. So actually, on net debt basis, we had net cash. And that felt pretty good going into a pandemic. So I felt then that in a pandemic, you can't have too little gearing.
Could you talk a bit about your approach to asset management, and if there's any recently completed initiatives that you could give us examples?
So what we mean by asset management is where we've bought an existing care home and there's an opportunity to physically change it. So we're not talking about repair and maintenance. Repair and maintenance is our tenant's obligation. They're responsible for doing regular repair and maintenance and paying for it, and we can enforce that through the leases. So asset management is where we're involves planning permission, and typically we're adding beds, we're adding an extension. So in 4 cases now, Freedom House in Oxfordshire, Diamond House in Leicester, we've added an extension which is for dedicated dementia care. We've got what we think of as kind of a classic project going on at the moment at Fairview on the A4 as you go into Bristol. So we bought Fairview in 2018, it's 2 units. It also illustrates this can be a long, painful process. We bought it with planning permission to link the 2 buildings. And then we worked out the design we inherited wasn't very good, so we redesigned it and had to reapply for planning. So it took us 3 years to get to the start line. This is always a slow, painful process. So we're going to end up at Fairview with a unified building with net 11 additional beds, very high quality. We're gutting one of the existing buildings, a 19th century Bristol Merchant's House, and reducing the beds in there from 20 to 14. So from the residents' point of view, we're going to end up with very high quality, spacious bedrooms, bathrooms, common areas. For staff, we're building brand new kitchens, laundries, staff training areas, so the staff have a much better environment. We're putting PV on the roof, rainwater collection, so environmentally it'll be better. So we, the landlord, end up with a bigger, the tenant has an easier building to operate, a better quality building to operate, residents, better place to live. We, the landlord, bigger building, more rent with some capital upside, and potentially quite substantial capital upside.
And what kind of lag do you expect between the completion of the asset management and it's showing through in valuation and revenue?
That's a debate we have with our valuers. And our valuers and auditors come at that from different directions. The auditors want the value to be recognised sooner rather than later, whereas the valuers quite sensibly are saying, prove it. It's all very well you built something, but show me you've opened it, the tenant's opened it successfully, it's trading in line with business plan. So cut to the point, I try and answer the question more directly. 12, 18, 24 months from practical completion.
And do you have any assets in the portfolio that you're looking to sell and that are classed as non-core? Or?
So the way we think about our portfolio is core, good quality buildings, standing assets will produce high quality income. There's no opportunity to change them, improve them. Value add, where we can do asset management, and a non-core. So non-core at the moment, we've got half a dozen out of 129 buildings. In terms of value, it's almost by definition, it's small. We sold one last year, one the year before. We're looking at options, what we do with the others. I think probably during the pandemic, we were initially a bit too cautious. We thought it wasn't a good time to be a seller. With hindsight, that was a mistake. It was a perfectly good time to be a seller. So we're reviewing what we do with the non-core assets. So I think it's important, a couple of things, but we've acquired them as part of bigger portfolios. And by being willing to give the vendor what they want, a clean deal, sell the whole portfolio, we got better terms on the whole thing. That's typically how we end up with non-core assets. So provided we haven't overpaid for them on day one, we know we can move them on as and when we need to, and we just need to get a move on and do that.
What is the impact of rising interest rates on the company's net earnings? How much of your debt is fixed versus variable?
Interesting question. So we had used for the first 4 years, we'd used our debt as an acquisition tool. So we've got 4 bank revolving credit facilities, which are not at fixed interest rates, and we drawn those down, acquired assets, and then refinanced the bank debt with equity. At the end of last year, we put our first long-term fixed rate debt deal in place. So we've borrowed 75 million, of which so far we've drawn down 38 million. We'll draw the other 37 million down in June this year. And that's at a fixed interest rate for 14 years of 3%. So to put things in perspective, the average yield on which we're acquiring assets is around 7%. So the difference between 7% net yield, 3% fixed interest rate is obviously very attractive. And our finance director he pulled a blinder off in December last year because we priced that debt at the peak of the Omicron scare when gilt yields were at a low. And I think if we're issuing that debt today, it'd be more like 3.5%, 3.6%.
Thank you. And there's another question here that says, do you use any third-party specialists in assessing the quality of your tenants or potential tenants? And do you have a target list of potential tenants?
The answer to yes to both. But we use third parties. We've got a panel of people we use for various aspects. Obviously, we do the classical things, surveyors. Everything we do is independently valued. We have a separate environmental team to look at the environmental performance of our buildings. We have people who can help us on operational performance. But we use, particularly on the operational side, those is reality check, sense check, a second, third view on that. The main responsibility there is on us. We need to make sure our team owns what we're buying, and we've got a clear view about what we think is as I mentioned earlier, to set the rent right, first you've got to understand very clearly what you think was sustainable performance of those buildings and businesses over the medium long term. And you've got to do that yourself. You've got to double, triple check it and get credible third parties to come in and verify it for you, but you need to do that. Yes, so we mentioned the fragmented market. This is an exercise we do every 3 months. We sit down and say, who's out there? There are a few names, which, forgive me, I will not name, who we know we don't want to do business with. There are a few people we want to do business with, we're talking to, and then there are always a few people who we haven't met yet and we need to go and talk to.
Thank you. There's another question. Can you talk a bit about your acquisition pipeline? What is the potential for further growth, i.e. what could this portfolio look like in 5 years' time? So
at the end of last year, we had 124 operating care homes. We've got a couple in forward funding and developments and a few things going on, but 124 operating care homes, 6,720 beds. So that gives us about 1.5% of the UK market. We're not thinking in market share playing monopoly terms, but so if we double or triple in size, we're still sub 5% of a very fragmented market. So we know we can grow. The gating issue, and I hope I'm not repeating myself, is tenants. Who are the tenants who are going to run those homes for you? But at any point in time, so at the moment in our current pipeline, this is where we've gone beyond doing desktop work, a few visits, we've got lawyers working, we're engaged. We've got the next 3 tenants. But the lead time between having the initial conversation, something happening, is 6, 9, 12 months. But we know who the next 3 tenants are going to be. And as long as we can keep that pipeline rolling and refreshed like that, at some point we will own enough care homes, we won't be able to diversify further by adding more, but that point is quite a long way off.
How much asset management can the team carry out in any given year? Is it a case of one project at a time?
No, so it depends what we mean by asset management. So at any point in time, asset management can range from the project I mentioned at Fairview is going to end up being about £3.4 million. Some asset management projects are £100,000, £200,000. They're quite small. And then we're looking at lots of small environmental improvements of different homes, which could be 50 to 100,000. So today we've got around 10 active asset management projects underway. The big addition we made to our team last year was we hired a wonderful guy called Simon Gould, who joined us in August. He had previously been another major UK healthcare REIT, not doing care homes, doing primary care. He spent 14 years developing primary care facilities around the UK. We're not going to get into the primary care business, but we've asked Simon to join us to work out how we can really ramp up our, not just asset management, also forward funding the development of new care homes on a pre-let basis. How can we get more ambitious? But our caution there is between wanting to be more ambitious, ramping up, and things happening, there is a long lead time.
I've got another question through. It's that what are the constraints on the potential size of the strategy? Is it the size of the investment team? Is the idea that the portfolio grows steadily over the long term? If there's something else.
I think the main constraint is making sure we are selecting and doing business with the right tenants. And one way of measuring that is our rent collection record continues to be as strong as it is. That's one way you can keep track of, are we choosing the right tenants, do business with the right people. Access to financing. So we have a lot of debt providers out there at the moment. The equity markets right now are quite challenging. So I think what worries me most at the moment is access to financing.
Thank you. What is the underlying level of occupancy in the portfolio, and is this still being impacted by COVID?
So we came into the pandemic, so we're now in early February 2020. Our average occupancy across the portfolio was 90%. And it took a 10% hit in the first wave. So in April, May 2020, it went from just under 90% to just over 80%. It stabilized, recovered slightly, and then it hit what we hoped was the all-time low in January 21, and the second wave at 79%. And it began to recover pretty steadily between April and December, about 5%, back to 84%. It then dipped down a little bit over Christmas, New Year, and Omicron, down about 1%, and now it's steadily increasing again. And we're pretty confident, and we know from talking to our home managers, there's a lot of pent-up demand out there. What it's going to take to translate that demand into normal occupancy, I think, is a couple of things. So one is people get confident the pandemic really is over, because clearly if there's any risk of more lockdowns, the last thing you want to do is put a relative into a care home when you might not be able to see them. So people delay that decision for as long as they possibly can. That's got to be the right thing to do. And secondly, I'm not criticising anyone, but before you go into a care home, there's a very thorough assessment process, care commissioning process. Lots of people get involved in that, particularly social workers and GPs. And with GPs and social workers working from home and not seeing people physically, it's really difficult to get those assessments done. People need to get back to working normally. And I'm afraid one thing you're going to find that when they do that is there's a lot of pent-up demand out there.
Thank you. What proportion of your income is from private pay versus state-funded residents?
So for the average, so the end of last year, 69% was state-funded. Of that, just under 10% is NHS, just under 60% is local authority, 31% private pay. We have some private pay in the state-funded. It's a complicated market, and there's an element of private pay in the state-funded sector where families are paying top-up payments, but we don't count that as private. So roughly 2/3 of our tenants' income is state-funded.
And do you have a preference for that, or?
We're neutral. I mean, there are pros and cons to both. There's obviously state funding is government pay, is pretty secure. Private fees tend to be higher, and margins can be higher in the private market. But we also think the top end of the private market is, funnily enough, counterintuitively, is where some of the biggest risks are at the moment, and where things may be slight in terms of values of buildings, but also have operators there lost that concept of value for money. And I think some people on this call might have relatives in care homes. I think many people listening might have children at private schools. And you know what it's like, if fees go up for 5% per annum indefinitely, they become unaffordable. And we think there's been an element of that going on in the private care home market.
We've got a question in that says, would you ever consider diversification into social housing? Do you have a view on that sector?
We review diversification options periodically. Our preference is to keep it as clear and simple as we can. We think the deepest value is in care homes. We think we can go on delivering reduced risk through adding tenants, through diversifying, by doing what we do. I would say social housing, very unlikely to go into that for a couple of reasons. It's a very different market, the way it's regulated, what the market drivers are, and we think it's a housing market. We do healthcare.
I think we've got time for one last question. What is the fund's dividend policy and is it fully covered?
So the dividend policy, we hope is very clear. As I mentioned, all our leases are inflation linked. So what we do in January each year, we look at the rent reviews we actually received during the previous year. So not the annualisation of percentage increase, just how many pounds additional rent did we receive the previous year from the rent reviews, and we increased the dividend by that much. So our dividend for 21 was 6.41p, the target for this year is 6.53p. So there will be a lag, because we know inflation's going up, our rent reviews will be increasing, there's going to be a lag before we pass that through into the dividend. Yes, and our dividend is fully covered. So the dividend we paid for 2021 was 126% covered by EPRA earnings per share, 105% covered by adjusted earnings per share.
Andrew, thank you very much for joining us today.